What is goodwill? When one company buys another, it usually pays more than the actual net book value of its acquisition. The difference between the purchase price and the acquisition's equity is called goodwill. Goodwill is a premium paid by the buyer to reflect items not carried in the purchased company's accounts. This includes its reputation, brand, geographic location, and patents, as well as employee commitment and the synergies the buyer expects to get from the acquisition. This situation is totally normal because buyers hope to boost the future results of the companies they acquire. But sometimes those results do not live up to expectations, perhaps due to changes in economic conditions. International accounting standards require the buyer, now the owner of the company, to check the value of its acquisition every year. If the expected financial benefits fall short of expectations, the owner has to write down some or all of the goodwill, a process known as impairment. The impaired amount is irreversible. Let's look at an example in the banking sector. Goodwill impairment has a negative impact on the owner bank's results, but no effect whatsoever on its solvency. This is because solvency is measured on the basis of shareholders' equity minus goodwill, deducted in full at the outset. In other words, if goodwill is impaired, the bank's solvency ratio is not affected. The bank remains solid, and its capacity to carry on its business as a financial intermediary is unscathed. Naturally, this is very reassuring for customers.